Welcome back to the channel, and thank you for joining me. I'm Algabot, your guide to the mechanics of automated trading systems for MetaTrader 5. Today we're taking a close, educational look at an expert advisor called Multi-Horizon Momentum Consensus. This strategy is built around a classic idea, time series momentum, but with a twist. It measures the market's push across 4 different time horizons at once, and only acts when all of them agree. By the end of this video, you'll understand how it reads momentum, how it decides to enter and exit, and how it manages risk with the average true range indicator. Let's dive in. So what exactly does this expert advisor do? At its heart, Multi-Horizon Momentum Consensus is a volatility-normalized, time series momentum system. Time series momentum simply asks a straightforward question. Is price higher or lower than it was a certain number of bars ago? If price is above where it was, momentum is positive. If it's below, momentum is negative. This is one of the most widely studied behaviors in financial markets, but a single look-back window can be noisy. A 20-bar push might be pointing up while the deeper drift is actually flat. To address that, this strategy doesn't rely on one window. It measures momentum across 4 geometrically spaced horizons, the BaseLookback, then double it, then 4 times, then 8 times. With the default base of 5 bars, that gives 5, 10, 20, and 40 bars. Each of those 4 momentum readings is divided by the current average true range, so they're all expressed in the same volatility comparable units. That normalization matters. It lets the strategy compare a fast move and a slow move on equal footing, regardless of whether the market is quiet or active. A position is only considered when all 4 horizons agree, when every one of them points the same direction at the same time. The idea is that a genuine trend announces itself at every scale, while choppy, mean-reverting markets tend to have the short and long horizons disagreeing. On top of that agreement, the average momentum must clear a magnitude threshold measured in ATR units, so weak, aimless drift is filtered out. Who is this style suited to from an educational standpoint? It leans toward patient, systematic, trend-following thinkers, traders who are comfortable waiting for broad alignment rather than reacting to every small wiggle. It can be studied on any liquid market and time frame, from foreign exchange pairs to indices and metals. Remember, though, that all trading carries risk, and this is a framework for learning, not a recommendation. Let's walk through the exact logic, step by step. The expert advisor works on closed bars, so it evaluates its rules once per completed candle rather than on every tick. That keeps the signal stable and avoids reacting to noise inside a forming bar. First, it calculates the average true range over the chosen period, 14 bars by default. This single number does 2 jobs. It normalizes the momentum readings, and it sets the distance of the stop loss and the take profit later on. Next, it computes 4 momentum values. For each horizon, it takes the close of the most recently completed bar and subtracts the close from that many bars earlier, then divides the result by the ATR. So we get momentum over 5 bars, 10 bars, 20 bars, and 40 bars, each expressed in ATR units. The strategy then counts how many are positive and how many are negative, and it averages them. Now the decision. A long signal is generated only when 2 conditions are both true. Every one of the 4 horizons is positive, unanimous agreement, and the average momentum is greater than or equal to the momentum threshold, which defaults to 1.5 ATR units. A short signal is the mirror image, all 4 horizons negative, and the average momentum at or below negative 1.5. Notice this is fully symmetric. Long and short use the same rules in opposite directions. There's one more gate that's easy to miss, but very important. The strategy only acts on the fresh transition into that unanimous state. In other words, it enters on the bar where consensus first appears, not on every bar the agreement persists afterward. This is deliberate. It aims to join a trend as it broadens out, rather than piling in late, after the move is already mature and extended. Once a position is open, the exit logic is decisive. If the opposite unanimous consensus appears, say you're long, and all 4 horizons flip negative, the position is closed immediately, and the next bar is free to rearm in the new direction. On top of that, every position is bracketed. The stop loss sits 2 ATR below the entry for a long, and the take profit sits 3 ATR above it, with the mirror for shorts. That's a reward-to-risk shape of 3 to 2, or 1.5 to 1, defined entirely by volatility. Only one position is held at a time. There's no adding to a winner. Let's look at the actual MetaQuotes language code the expert advisor runs, just as you'd see it in MetaEditor. At the top are the inputs. BaseLookback, defaulting to 5, sets the shortest horizon, and the 4 horizons become 5, 10, 20, and 40 bars. MomentumThreshold, at 1.5, is the minimum average vol-adjusted momentum in ATR units, needed to call something a trend. ATR period is 14, and it drives both the normalization and the stop and target distances. The ATR stop and target multipliers, 2 and 3, set those brackets in ATR multiples, and lots is the position size. In the middle block, you can see the loop that builds the 4 momenta. It takes the close of the just completed bar, subtracts the close from each horizon back, and divides by ATR. It tallies the positive and negative counts and sums them for the average. Then come the 2 signal conditions. The long condition is true only when the positive count equals 4, all 4 horizons up, and the average momentum is at or above the threshold. The short condition is its exact mirror. All 4 counts negative, and the average at or below the negative threshold. Look at the buy block. When the long condition is satisfied and the state wasn't already long, it reads the ask price, places the stop 2 ATR below, the target 3 ATR above, and calls trade.buy. The sell block does the reverse. It reads the bid, sets the stop 2 ATR above, the target 3 ATR below, and calls trade.sell. The state check before each is what enforces that fresh transition rule we discussed. Clean, symmetric, and fully volatility scaled. Now let's bring it all together on the chart and watch both a long and a short playout step by step. On the lower panel, you'll see a single reading, the average vol-adjusted momentum across all 4 horizons, measured in ATR units. There's a green line at positive 1.5, the long threshold, and a red line at negative 1.5, the short threshold, with a 0 midline in between. Watch how the market interacts with those levels. Look at the first few candles on the left. Price is drifting sideways in a tight range, and the momentum reading is hovering close to 0, flicking slightly positive, then slightly negative. This is exactly the kind of choppy, indecisive market the strategy is designed to sit out. The short and long horizons are pulling against each other, so there's no consensus, and the average never gets near either threshold. The expert advisor stays flat and waits. Then the character of the market changes. A stronger bullish candle appears and closes well above the recent range. As it does, the shorter horizons swing clearly positive, and because the drift has been quietly building, the longer horizons are positive too. All 4 now agree, and the average momentum reading pushes up through the green threshold line at positive 1.5. That's the fresh transition into unanimous up consensus, and you can see the buy entry marker print right there. This is the moment the strategy has been waiting for: broad, one-way agreement across a 16-to-1 span of horizons. The instant that long is opened, the brackets are set. The stop-loss rests 2 ATR below the entry, tucked beneath the recent basing action, and the take-profit target sits 3 ATR above. Now follow the next few candles. Price accelerates upward, each candle closing higher than the last, and the momentum reading climbs further into positive territory, confirming the trend is broadening rather than fading. Price reaches up into the take-profit target, and the position is closed for a completed move. Notice the reward-to-risk geometry here. The target is 3 ATR while the risk was 2, a shape defined purely by volatility, not by guesswork. After that peak, the market rolls over. A candle closes back down, and the momentum reading falls away from its highs, dropping back below the threshold. Consensus has broken, and the strategy is flat again, patiently reassessing. It does not try to catch the very top. It simply lets the agreement dissolve. Now watch the second setup form on the right. Price begins stepping lower, candle after candle. As the decline deepens, the shorter horizons turn negative first, and then the longer horizons follow as the downdrift accumulates. All 4 horizons line up to the downside, and the average momentum reading pushes down through the red threshold at negative 1.5. That's the fresh down consensus, and the sell entry marker appears. The logic is a perfect mirror of the long, same rules, opposite direction. With the short open, the stop loss is placed 2 ATR above the entry, above the small rollover high, and the take profit target sits 3 ATR below. From there, price works steadily lower. Each red candle deepens the move. The momentum reading stays pinned below the short threshold, and eventually price reaches down into the take profit target, closing the trade. Step back and look at the whole sequence. In both cases, the strategy ignored the flat chop, waited for every horizon to agree at once, entered only on the fresh transition into that agreement, and let a fixed, volatility-based bracket define both the risk and the objective. That is the core discipline of multi-horizon momentum consensus. Trade the minority of moments when the whole market is pointing one way and stand aside for the rest. Of course, not every signal reaches its target. Some will reach the stop instead, and that is a normal part of any trend-based approach. That brings us to the end of our deep dive into multi-horizon momentum consensus. We covered how the strategy measures momentum across 4 geometrically spaced horizons, how it normalizes each reading with the average true range, how it demands unanimous agreement plus a magnitude threshold before acting, and how it brackets every position with volatility-based stops and targets. We also walked through the code and a full long and short example on the chart. Remember, everything here is for educational purposes only. It is not financial advice, not a recommendation, and not a solicitation to trade. Trading involves real risk, and losses do happen. Always do your own research and test any idea thoroughly before risking capital. If you found this helpful, please like the video, leave a comment with the strategy you'd like me to break down next, and subscribe for more MT5 strategy analyses. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.